Who's winning in this economy right now?
The rich, guys like me. You know, we have gone from having 93 billion, top 400 in 1982 to having 2.4 trillion, 25 for 1.
Consider the year 2008, a global financial crisis that shook the world, turning millionaires into paupers overnight. Now, fast forward to 2024, and whispers of recession are growing louder. But even in this economic turmoil, there's a silver lining. A strategy to not just survive, but thrive. Today, we're going to reveal how you can apply Buffett's wisdom to multiply your $1,000 during the looming 2024 recession. Let's talk about the economic landscape of 2024.
When people start to think, well, this could be the beginning of something really bad, it could be even a World War III situation, it could be a return to the Cold War. Does any of that ever go through your mind?
Well, if you tell me all of that's going to happen, I will still be buying the stock.
A year that's shaping up to be quite challenging. Economic indicators across the board are pointing towards a looming recession. But as Warren Buffett wisely puts it, be fearful when others are greedy, and greedy when others are fearful. This period, daunting as it may seem, is ripe with unique opportunities for the savvy investor. History has shown us that recessions, while tough, often open the doors to some of the greatest investment opportunities. During the 2008 financial crisis, a time of widespread panic and economic turmoil, clever investors were able to spot and capitalize on undervalued assets. This wasn't just luck or coincidence. It was a result of understanding market cycles and recognizing that economic downturns often lead to mispriced investments. For example, the stock market, which saw a significant drop during the crisis, also presented discounted buying opportunities for companies that were fundamentally strong but temporarily undervalued. Now, as we stare down the barrel of 2024, similar patterns are beginning to emerge. The global economy is showing signs of strain, with several key indicators flashing red. Consumer debt is at an all-time high. Global trade tensions are creating market uncertainties, and inflation rates are beginning to creep up, affecting purchasing power. These factors, combined, are creating a perfect storm for a potential recession. But what does that mean for someone looking to invest or grow their wealth? It means that while the general market sentiment might be leaning towards fear and pessimism, there are hidden gems waiting to be discovered. Buffett's approach in such times has always been to focus on value investing, finding companies that are undervalued by the market but have strong fundamentals and the potential for long-term growth. Moreover, the expected recession could lead to lower asset prices, making it an ideal time to buy into markets that would otherwise be too expensive. Real estate, for example, could see a correction, presenting more affordable entry points. The key here is to conduct thorough research and look beyond the short-term market noise. However, it's crucial to approach this with caution. Investing during recession requires a solid understanding of your risk tolerance and investment goals. It's not about trying to time the market perfectly, but about making informed decisions based on sound financial principles. Now let's find how you can smartly invest $1,000 during the 2024 recession. Warren Buffett has always been an advocate of making intelligent investment choices, especially during economic downturns. He famously said, "Do not save what is left after spending, but spend what is left after saving." This principle is crucial when considering how to allocate a limited amount of capital, like $1,000 in a recession. In a recession, the market is often filled with undervalued assets. This is where your $1,000 can truly make a difference. The key here is to identify opportunities where others see despair. For example, look at stocks of companies with strong fundamentals, those with solid balance sheets, good cash flows, and competitive advantages in their industry. During a recession, these stocks might be trading at prices much lower than their actual worth. Another smart move could be investing in index funds or ETFs. These funds offer diversification, which is vital in managing risk, especially in volatile market conditions. Buffett himself is a known proponent of index funds for their low fees and diversification benefits. For a beginner investor with $1,000, an S&P 500 index fund could be a great start, as it gives you a piece of the top 500 companies in the U.S. Real estate could also be an interesting sector to explore during a recession.
They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation.
With property prices potentially lower, your $1,000 could go towards a down payment for a rental property or a real estate investment trust that offers exposure to real estate markets without requiring large capital. Moreover, consider the burgeoning field of digital assets. Cryptocurrencies and blockchain technology, for example, have been gaining traction. While they come with higher risk, allocating a small portion of your $1,000 to this sector could offer high rewards in the long run. It's important to remember that investing $1,000 during a recession requires patience and a long-term view. The goal is not to make quick profits, but to invest in assets that will grow in value over time. As Buffett advises, our favorite holding period is forever. Think of your $1,000 as seed money for your future financial garden. Plant it wisely, nurture it, and watch it grow over time. Let's enhance our understanding of investing $1,000 during the 2024 recession by introducing some practical calculations. Warren Buffett, known for his analytical approach, always stresses the importance of numbers in making investment decisions. He advises, never invest in a business you cannot understand. Let's consider the potential of the gold market. Warren Buffett has a complex view on gold, often focusing on productive assets. However, he acknowledges the value of gold as a hedge against inflation and economic uncertainty. Investing in gold, especially during turbulent times like a recession, can be a wise move. Gold has historically been a safe haven in times of economic instability. With your $1,000, you could invest in physical gold, such as coins or bullion, or opt for gold ETFs, which are exchange-traded funds, which offer easier liquidity and don't require physical storage. The choice depends on your preference for physical assets versus market-traded ones. The return on a gold investment can vary based on market conditions. For example, during the 2008 financial crisis, gold prices saw a significant increase. According to historical data, gold prices surged from around $800 per ounce at the start of 2008 to over $1,200 per ounce by 2010, a 50% increase. Applying this to a $1,000 investment, if a similar pattern occurs during the 2024 recession, your investment could potentially grow to $1,500. While gold doesn't offer dividends or interest, its value often appreciates over time, especially during economic downturns. It's a long-term investment that can diversify your portfolio and protect against inflation. The key is to monitor the market and understand that gold prices can be influenced by various global factors. In short, investing your $1,000 in the gold market can be a smart defensive strategy during a recession. It offers a hedge against market volatility and inflation, aligning with Buffett's principles of understanding and cautiously navigating market uncertainties. The question now is, are you considering gold as a part of your investment strategy? And how will you balance it with other assets to optimize your portfolio's performance? Redefining the approach to investing your $1,000, let's consider an often overlooked yet potentially lucrative avenue, investing in yourself by learning a new skill. Warren Buffett himself has emphasized the value of self-improvement, stating, "The most important investment you can make is in yourself." Let's explore how this investment can yield substantial returns, supported by data from platforms like Glassdoor, Indeed, and LinkedIn. Suppose you use your $1,000 to enroll in a course or training program in a high-demand field such as digital marketing, coding, data analysis, or graphic design. The cost of such courses varies, but many comprehensible programs are available within this budget. Upon completion of your training, the increase in your skill set can significantly boost your employability and earning potential. For example, according to Glassdoor, the average annual salary for a digital marketer in the United States is around $57,000 per year, while entry-level coders can earn an average of $60,000 annually. Data analysis and graphic designers also see similar competitive starting salaries. The return on investment for such skill development can be substantial. If your new skills lead to a job paying $57,000 annually, compared to a previous salary of $40,000, that's a $17,000 increase in yearly income. Over a 10-year period, this equates to $170,000 return on your initial $1,000 investment in education, not accounting for potential raises and promotions. Beyond the direct financial gains, investing in skill development offers other benefits. It enhances your job security, opens up new career opportunities, and can lead to greater job satisfaction. Furthermore, skills like coding or digital marketing can provide avenues for freelance work, adding an additional stream of income. In the end, investing your $1,000 in skill development aligns with Buffett's philosophy of investing in yourself and can lead to significant financial returns and career growth. Next, you need to decide what skill you want to work on and how you will use it to make the most money in the years to come. Let us move on from talking about investment choices to talking about the power of compound interest, which Warren Buffett often says is one of the most important parts of investing. He famously stated, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Understanding this principle is crucial, especially when working with a modest sum like $1,000 during a recession. Compound interest, simply put, is the interest on your interest. It's the process where the value of investment grows exponentially over time because the interest earned grows not only on the initial principal, but also on the accumulated interest. This concept is a powerful tool in the investor's arsenal, particularly during economic downturns where every dollar counts. Let's apply this to your $1,000 investment. Assuming you've diversified your portfolio as discussed, and you achieve an average annual return of 7%, in the first year, your investment grows by $70, bringing the total to $1,070. In the second year, you earn interest on this new amount, so 7% of $1,070 is about $74.90. Making your investment worth approximately $1,144.90. This process continues each year, and the amount grows progressively larger due to the interest compounding. Over a longer period, this growth becomes more pronounced. After 10 years, at a consistent 7% return, your initial $1,000 could grow to about $1,967.15, almost doubling your investment. This calculation illustrates how compound interest accelerates the growth of your investment over time. During a recession, when investment returns might fluctuate, the principle of compound interest remains a sign of hope. It encourages long-term investment strategies and patience, aligning perfectly with Buffett's investment philosophy. It's not about quick gains, but about steady growth over time. Moving forward, let's focus on diversification and risk management, which are crucial strategies during economic downturns. Warren Buffett himself has a history of diversifying his investments, a tactic that has significantly contributed to his success. He once said, "Diversification is protection against ignorance." It makes very little sense for those who know what they're doing. While this might suggest a preference for concentrated investments, it also shows the importance of understanding and managing risk, especially with a limited sum like $1,000. Historically, diversification has been a key to resilience during recessions. For example, during the dot-com bubble burst in the early 2000s, investors who had diversified portfolios were better shielded from the tech sector's dramatic downturn. Similarly, in the 2008 financial crisis, those who had spread their investments across various asset classes, including stocks, bonds, and commodities, experienced less volatility compared to those heavily invested in real estate or financial stocks alone. For your $1,000 investment in the 2024 recession, diversification means not putting all of your money in one stock or one sector. It involves spreading out your investment across different assets, which could include a mix of stocks in various sectors, bonds, and perhaps a small portion in emerging markets or alternative investments. This strategy helps in balancing the risk. If one asset class underperforms, the others might compensate. As we progress to our final chapter, let's emphasize the importance of a long-term perspective in investing, especially during the 2024 recession. Warren Buffett's success is largely attributed to his long-term outlook. He famously said, "Our favorite holding period is forever." This approach is crucial when investing your $1,000, as short-term market fluctuations can be misleading. Historical records consistently show that patience pays off in the investment world. For instance, during the 2008 financial crisis, investors who held on to their investments and resisted the urge to sell in a panic generally saw their portfolios recover and grow in the following years. The key lesson here is endurance. In 2008, the S&P 500 experienced a significant drop, but by 2010, it had started to rebound. Investors who maintained a long-term view and continued to invest, even in small amounts during the downturn, were able to capitalize on the market's eventual recovery. You have to decide if you can keep this long-term view and stay the course, even when things get rough. In conclusion, managing the 2024 recession with a $1,000 investment requires a blend of strategic thinking, patience, and long-term perspective, guided by Warren Buffett's timeless wisdom. Remember, the greatest opportunities often arise in times of uncertainty. How will you apply these strategies to grow your investment during the recession? Share your thoughts and plans in the comments below, and let's discuss how to turn challenges into opportunities in these turbulent economic times.